Maybe this will work. Better? Okay, good. Okay, so if you have an effective tax rate, for cost of debt is the same rule or what? For cash flows, you can end up using the effective tax rate and justifying it, but for cost of debt, what's the rule? Always marginal tax rate. Why is that? Why do we have two sets of rules? Why am I allowing you to use effective tax rate when it comes to operating income, but insisting on using marginal tax rate when it comes to cost of debt? Good question. Maybe I should add this to the quiz on Wednesday. What's the difference between the two cases that allows me to have two sets of rules? Do you get the question? Yeah, you guys look a little dazed, so I want to make sure everything's okay. So when we use after-tax operating income, we take operating income times 1 minus T. I said there I can live with you using effective tax rates, at least for the near term. But when you talk about cost of debt, it's always got to be the marginal tax rate. Think of what we're doing. When we take operating income and multiplying by 1 minus the tax rate, we're taking the entire operating income of the company and we're looking at the after-tax portion, right? So if your effective tax rate is low, then over the entire operating income, you're going to save on taxes. But when you do cost of debt, we try and capture tax benefit from interest expenses, right? Which always happens at the margin. I don't care if you have $50 billion in income, you don't cover the first billion or the second billion, you cover the last billion with your interest expenses. Interest expenses save you taxes at the margin. You always use the marginal tax rate there. But when you're looking at overall operating income, you can at least get a little more flexibility and use a tax rate that is lower than the marginal tax rate, but again, only for the short term. Let's complete the tax story. Do companies lose money sometimes? Especially in years like now, a lot of companies lose money. Let's carry this to the next step. When you lose money from a tax perspective, first, do you have to pay taxes that year? This is a stupid question, but humor me. Thank God you don't. If you lose money, you don't have to pay taxes, right? Then what does the government allow you to do with that loss? Accrue it and carry it forward, right? So if you lose money 3 years in a row, 4 years in a row, 5 years in a row, you get this item called the net operating loss that you'll see reported in the 10K. This company has 2 billion, 3 billion, 5 billion in NOLs. I want to kind of tie up that loose end. What if you are valuing a company with net operating losses? And many of your companies will have net operating losses coming in and might accumulate on those losses. Okay? There are two ways people deal with net operating losses. One is they act like there are no net operating losses, value the company based on a tax rate. Then at the end of the process, they would say, this is the tax benefit from NOLs. Okay? I don't think that's a good way to do it, and here's why. Let me give you an example. Let's assume that I come to you with a company which has an NOL of $1 billion. Okay? So it's accumulated these losses over the last 8, 10, 7 years. It's expected to start making money next year. 500 million next year, 500 million the year after, 500 million year 3. So you have an NOL of $1 billion, 500 million in operating income each year for the next 3 years. These are your expectations, but let's say they're reasonable expectations. From a tax perspective, tell me how much you're going to pay in taxes in year 1, year 2, and year 3. First, in year 1, how much are you going to pay in taxes? You're going to pay 0 in taxes. Your NOL is carried forward. It's going to shelter your income in year 1, right? So you have a $500 million left over. Year 2, 0 again. Year 3, you're going to have a 40% tax rate. So what's effectively going to happen is your cash flows in years 1 and 2 will be higher because you didn't pay taxes. In year 3, you're going to start to pay taxes. You built your NOLs into your cash flows. And by doing it this way, there are two differences. One is you take into account the present value factor, which is you don't get the tax benefit immediately. And the second is you build in the uncertainty about the cash flows into the present value. How do you do that? I mean, here, for instance, you save 200 million in taxes in year 1, 200 million in year 2, right? So your cash flows in years 1 and 2 are going to be higher by 200 million because you don't have taxes. You discount those back at what rate? At your cost of capital. So if you're a risky company, that present value of your losses will be smaller than if you're a safe company. Okay? What I'm trying to contrast is the way a lot of people deal with NOLs. Investment banks, for instance, they will take the NOL and multiply it by the tax rate. In this case, they will take the $1 billion, multiply by 40%, and say your tax savings are going to be 400 million. The mistake with doing that is you're assuming you get it immediately, which you don't. Second, you're assuming there's no uncertainty about getting it, which there is. And you're going to overstate the tax benefit if you just take the NOL and multiply by the tax rate. So if you have losses that you're carrying forward, the best thing to do is build it into your cash flows in the form of tax savings you're going to get in the early years because of the losses. And once you run out of the NOL, then revert back to a marginal tax rate or a reasonable tax rate. Any questions at all about taxes? Yes? First, make sure the IRS, see, IRS knows you're doing this, right? Let's face it, the IRS is not incredibly stupid. They might be mildly stupid, but they have they're single-minded about it. They want to collect more in taxes. So when they see you acquire a firm with an NOL, the first thing they will try to do is make it as difficult as possible for you to take the NOL of the target company and use it on your company. You look at the rules that you got to meet to be able to set NOLs against profits. I mean, there are 16,000 rules you got to follow. So first, make sure you follow all the rules. Second, make sure you have the income to cover that NOL. So if you have a $2 billion NOL and your profits are $800 million, you can't assume it's going to happen immediately, right? There might be special cases where you have a huge operating income and you're getting an NOL, you can get the but it's going to be the exception rather than the rule, right? Well, but the problem with JP Morgan is they're losing money. So what's the point of acquiring another NOL to put on top? So in a sense, all they're accumulating is more NOLs to carry forward. But if you're a money-making bank and you acquire a money-losing institution, it's not automatic that you can offset their losses against your profits. Okay? There are a set of tax rules you got to meet. You got to restructure the company. So it's not easy to actually offset losses against profits and acquisitions. We'll come back and deal with this when we do the acquisition valuation part. But it is actually very difficult to meet those standards. But if you do, then maybe you can get the tax benefits immediately. But you don't want to jump to that conclusion that it's going to happen automatically and then find yourself surprised when it doesn't happen. Okay. Any other questions on taxes? Yes, Kevin.
Any special provision for companies that put aside a huge tax allowance
Did everybody get the question from there, Kevin? Which is, sometimes companies know there's a tax provision, there's a tax expense coming up, so they might set aside a provision. A provision is not a cash flow, right? I mean, that's an accounting device that they've done. So if you're working purely with cash flows, I'm not sure the provision is even going to impact your cash flows that much. So that's the accountant just smoothing out things over time. When you're dealing with cash flows, you have to do the smoothing out yourself. So in that case, it's better to actually take the NOLs as they are and work it through on your own rather than trust the company to do it for you. So that's basically, we're still at EBIT times 1 minus C. Let's move on because we've got to get to the free cash flow to the firm, right? We have CapEx, depreciation, working capital still out there. Let's talk about CapEx. Here's the essence of CapEx. CapEx is expenditure designed to create growth in the future, right? So if you're a manufacturing firm, a factory is obvious CapEx. With a technology firm, we said R&D is CapEx. With a human capital firm, we said recruiting and training expenses is CapEx. If you're a consumer brand company, Coca-Cola, you could even make the argument that a big portion of your advertising is CapEx, right? You see why? Because a lot of that CapEx, I mean, here's the test of CapEx, is if you took that expense out this year, if you cut it to zero, will your revenues be affected this year? And the answer is no. Then it's really CapEx because you're doing it for some expenditure in the future. So if you're advertising just to build up brand name, it's very unlikely that people are going to buy fewer Coke bottles this year because you didn't do the advertising. So the first thing that we want to do with CapEx, the first thing we want to do with CapEx is kind of expand the definition beyond the accounting definition of CapEx. Okay? A general proposition. Whatever you assume about CapEx and whatever you assume about growth has to be internally consistent. In other words, you come and tell me you have a high growth company. When I look at your CapEx line item, I should expect to see a large CapEx to sustain that growth. It's not going to happen automatically. In fact, one thing we'll talk about in the context of growth is preserving that consistency between what you assume about growth and what you assume about CapEx. Okay? But here are the items I'd like to think about when I think about CapEx. Oh, there's finally working. One is things like R&D. I want to treat as CapEx. We've already talked about how to do that, right? Treat the R&D expense as CapEx. Treat the amortization of the R&D as depreciation. Take that net amount and add it on to CapEx. But here's the other item that I think we miss when we think of CapEx. Some companies grow through acquisitions, right? They acquire other companies, and that's how they create growth. That's fine. Let's say you're valuing such a company. Let's take an example, GE. GE between 1986 and 2000 grew earnings about 9% a year. But half of that growth each year came from acquisitions. So let's say it's 2001. You're sitting down to value GE. You sit down, you project earnings growth of 9% for the next 10 years. Why? Because that's what they pulled off for the last 15. So far, that's pretty reasonable, right? Then you sit down to project out the cash flows, and when it gets to the CapEx line item, you go to the statement of cash flows for GE to see what their CapEx is. Accountants will put traditional CapEx in the CapEx line item. Acquisitions, where do you find them? If they're cash acquisitions, they're going to show up as, in the statement of cash flows, as other investing activities, maybe something like that. If they're stock acquisitions, God help you, because I don't even know where you'd find them. You'd have to dig through the footnotes. Somewhere in the footnotes, they're going to say, well, GE acquired this company and paid for it with stock. If you're not careful, if you stick with the traditional CapEx line item, do you see the inconsistency you create in your valuation? Your growth is going to reflect the 9% that you got with acquisitions. But when you do CapEx, you're going to count only the traditional CapEx. You're having the good stuff from acquisitions. You're not counting in the bad stuff. The basic rule with acquisitions is if you're going to count the growth from acquisitions in your top line, you've got to pay for those acquisitions in your CapEx line item. And I don't care whether you use cash or stock. Don't fall for that trick of it's not a cash flow. I would CFO say, well, I did an acquisition, I used stock, therefore it's not a cash flow. Says who? Because all you did was skip a step, right? No, the step was if you'd taken the stock, issued it to the market, taken the cash, and done the acquisition, it would have been a cash flow. You did barter, and therefore you want me to ignore it because it's not a traditional cash flow. So all acquisitions, whether they're paid for with cash or stock, should be treated as part of CapEx if you want to count the growth from that CapEx. If you want to ignore acquisitions altogether, that's fine. Then remove the growth from the top line, remove the acquisitions from the CapEx. The only problem with that is if you're valuing a company like Cisco, where 80% of its growth comes from acquisitions, removing acquisitions is a very artificial way of dealing with the valuation, because that's really going to what's going to determine whether Cisco should be worth $25 per share or $12 per share. So when we talk about CapEx again, think in broad terms. Don't think in terms of just traditional CapEx. Think in terms of R&D, investments in human capital, and acquisitions. And with stock acquisitions, check through the footnotes. Make sure that you catch all the acquisitions, because if you don't, you're going to be counting the growth and not counting the cost. Any questions on that? In fact, with stock acquisitions, there's one more little loose end. For instance, I did this with Cisco last week because I was valuing Cisco for something else. So I had to go through their 10Ks. And looking through the footnotes, I was able to find how many acquisitions. So they list the companies acquired. About half the companies acquired with cash, half with stock. They list the number of shares they paid on the acquisitions, but they acquired with stock. But to put a cash flow number on it, what else do I have to look up? I know the number of shares I used on June 16th to buy a company. I have to look up the stock price on June 16th. It's a pain in the neck. I wish I didn't have to do it, but there's no choice, because so much of the CapEx for Cisco comes from that form of CapEx. It's acquisitions. So I'll take you back to 99. I mean, the number, in fact, Cisco still does this. Last year they had 17 acquisitions. In 99 they had 9 acquisitions. In 99 also, for those of you who don't remember, there were 2 ways in which you could account for firms. You could do purchase accounting or pooling accounting. And therein actually is a clue as to whether they use cash or stock. The only way you can use pooling is if you use stock on your acquisitions. So those 3 acquisitions were stock-based acquisitions. These 6 were cash-based acquisitions. So these 6 I was able to pull off the statement of cash flows because they actually told me how much they paid. These 3 I had to back into by looking at the number of shares used in the share price in the day. The total amount that Cisco spent in that 1 year on acquisitions was $2.5 billion. That was their big CapEx. It wasn't building factories. It wasn't traditional CapEx. It was acquisitions. Yeah.
So you just went and looked at the stock price that day.
Exactly.
And just multiplied it by the share.
That's it.
What if the firm offered another price?
Like what? Doesn't matter, right? If you're paying in shares,
Yeah.
there's no price to offer. It's the share price times number of shares, right?
Okay, so then
It's an exchange ratio. Basically, that's what's going to determine. And to determine how much you ended up paying, all you have to do is take the number of shares in aggregate that you paid on the acquisition times the share price. You're done. Nothing else to do. Right? So the price becomes a function of the share price then on that particular day. Right? Yes? your cash inflow then from that, right? Is that what you're asking? If you divest assets, should I count that? That's actually a good question, because I'm treating CapEx always as a cash outflow. You're saying, what if companies systematic? And if they do it once in a while, then you can ignore it, right? Because it's already happened in the past. But let's say a firm consistently divests assets and acquires new assets. If the divestiture is continuous, it's consistent, you'd net it out against the acquisitions.
Even if it is not consistent, if you are valuing GM and you know that you want to sell that, you should invest that into the valuation.
No, but remember, if your earnings reflect only what's going to be left in the firm, you've already reflected the fact that 30% of the business is gone, right? So if it's a divestiture, the question to ask yourself is, are the earnings that I'm forecasting reflecting the 70% of the company left over? If you're forecasting the entire 100%, then you have an issue with the divestiture, right? Because then you got to build it in. Easier thing to do is if you know what's been divested, you know what's gone because of the divestiture, when you do the forecast only what's left in the company rather than the total company. Right? So here's my Cisco's total net CapEx number. I looked at the traditional statement of cash flows CapEx number, and according to the accountant, Cisco had CapEx of $584 million, depreciation of $486. Net those two numbers out. It looks like Cisco's spending almost nothing in net CapEx, $98 million. It's only when I bring in R&D, which adds another $1 billion, and acquisitions, that I end up with a true CapEx at Cisco of $3.7 billion. So when I do my cash flows for Cisco, if I just focus on traditional net CapEx, I'm going to overstate the cash flow. The true cash flow is a much more negative number because they reinvested this. I'm not actually hurting Cisco by doing this, because by factoring in the reinvestment, when I project my growth out, I'm going to give them a much higher growth rate. So I'm not doing this for good or bad. I'm just getting to get a much better sense of what the company is actually doing. You need to get a sense of what their true total reinvestment is, not just the stated CapEx depreciation number. Yes?
I understand that you're going to help them out with the growth rate here, but how are you going to hurt them by it?
Because the cash flows will be more negative, right? So they'll have a high growth rate, but the net CapEx each year, which will make the cash. So the net effect could be positive or negative. It will depend on whether they're paying a good price for the acquisitions or a bad price for the which is the way it should be. If you're growing through acquisitions, you can ruin yourself by doing it, or you can create value. I'm bringing in the good stuff through the growth rate, the bad stuff through the negative cash flow. The net effect might be positive or negative. Right? Any other questions? Yes? You have to. So that's always a problem. If the acquisition happened in October of 2008, you get a lot of companies do pro formas where they actually don't just reflect one quarter. They'll actually do it as if the whole year's revenues are, because otherwise you can't do year-to-year comparisons. You'd be surprised how many companies actually will state a pro forma with the combined company, because they do that for their own purposes, because when they do the year-to-year comparisons, then they can compare apples and apples. But if they haven't done it, you'll have to do it. I mean, let's face it, valuing an acquisitive company is a pain in the neck. Part of the reason when you see valuation or accounting scandals, they happen so often with acquisitive companies. You can hide a lot of terrible stuff behind acquisitions and the noise they create in this process. Yes? Of what? Of acquisitions, you'll see it as a number, right? Because you don't have to calculate it. The amortization of acquisition will be a line item if it does show up, but it'll show up in the years after the acquisition. So when you see depreciation and amortization in the company, it includes amortization of previous goodwill anyway. So unlike R&D where you had to concoct the number, acquisition should already be in there. No, you always can amortize. The question is what rate you amortize. The only difference across countries is what rate you amortize the goodwill at, right? Some countries it's a fixed schedule. Other countries you have to impair the goodwill. That's really the debate between countries, is what you do with the goodwill rather than whether you amortize it. Some countries still have the fixed schedule. We write it off over 20 years, but those are the exceptions rather than the rules now. Working capital. What's your accounting definition of working capital? Current assets minus current liabilities, right? I'm going to modify that definition a little bit for valuation perspective. First, instead of looking at current assets, I'm going to look at non-cash current assets. This is something we did in corporate finance as well, but I want to remind you why we do this. When we talk about current liabilities, I'm going to look at non-debt current liabilities. You know what I mean by that? If you look at the current liabilities, you have short-term debt, short-term portion of long-term debt, accounts payable, supplier credit. I'm going to focus only on the non-debt portion. Let me explain why I'm going to do each side. First, let's take the easy side. Why non-debt current liabilities? Earlier when we talked about cost of capital, and we talked about what we'd use as debt in cost of capital, We said we're going to include all interest-bearing debt, short-term as well as long-term. So basically, that short-term portion of long-term debt has already played a role in the valuation through the debt and the cost of capital. That's why you don't want to double count it. So what's going to be left? Accounts payable, supplier credit, other current liabilities usually. Okay? And you might have deferred items of one kind or the other. Yeah? So non-interest-bearing current liabilities. Why non-cash current assets? This is trickier. You know why working capital drains cash flows? For instance, let's take a classic working capital item, inventory. When you have more inventory, let's say you're a retailer, you look at your shelves and you see more inventory. Why does it drain your cash flows? You paid for that stuff, it's sitting on the shelves. While it's sitting on the shelves, you don't make any money. It's a classic wasting asset, right? So inventory is a wasting asset, it drains your cash flows. Accounts receivable, especially if you grant credit and you don't make interest in the period, is a wasting asset. Is cash a wasting asset? It used to be, at one point in time, it used to be a wasting asset, not that long ago. You know, there used to be laws in the US that restricted how much banks could pay as interest on cash deposits made with them by corporations. Banks loved it. Because the restriction was you can't pay more than 3%. Banks would say, I can't pay more than 3%. So they take your $3 billion deposit, pay you 3%, and then turn around and lend it at 12%. What broke that tyranny was Merrill Lynch inventing the money market fund. Basically, an individual started doing it. Corporations said, why are we leaving $3 billion in the bank earning no interest rate or a low interest rate? 30 years ago, you could see a rationale for treating cash as a wasting asset because if you had a lot of cash, you did not earn a fair market rate of return. Today, if you have a lot of cash, it's hopefully not sitting in a checking account somewhere. Right? It's either invested in T-bills or commercial paper, earning a low rate of return, but a fair rate of return. You might say it's only 2.5%, but that's what you should make on a riskless short-term investment. Think in net present value terms. You invest cash in T-bills. What's the net present value of investing in T-bills? It should be 0. You make 2%. That's what you need to make. It's a riskless short-term investment. Cash is no longer a wasting asset. That's why this debate you often hear in valuation rooms about operating cash versus non-operating cash completely misses the point. When McKinsey, for instance, has these rules, 1% of revenues operating cash, we will treat them as part of working capital. So you're sitting there debating, in this business, should cash be 1% of revenues or 2% of revenues? I don't care whether it's operating cash or non-operating cash. What I care about is it wasting cash or non-wasting cash? Let me give you an example. Walmart. McKinsey's rule for retailers is operating cash is 2% of revenues. They say that's what, because retailers need a lot of cash to run their businesses, 2% of revenues. What was Walmart's revenue last year? $250 billion? What's 2% of $250 billion? $5 billion? You think Walmart leaves $5 billion sitting around making no interest? In fact, if you look at if you hang around Walmarts for long enough, you'll see a Brinks truck drive by almost every hour, clearing out the cash registers because they sweep the cash in an interest-bearing account. At the most, you might have 10 or 15 million at any point in time, maybe 25 million floating around, not earning interest. But their objective is to get that cash into a fair market account to earn a fair market rate. So my rule with almost any company with a big cash balance is to ignore the cash balance when I do working capital, and I justify it by saying, hey, you know what? That cash is not wasting cash. I don't care if you need it for operations or not. Since it's not wasting cash, I'm not going to treat it as part of working capital. The only exception is if you ran a business where you really needed ready currency. I don't know what that business might be. Drug dealer in Colombia or something, it's, I value my business, then maybe I would treat cash as part of working capital. But first place, I wouldn't be accepting that assignment, because it might be a dangerous assignment if I get it wrong. But when you think about cash, think about wasting, non-wasting, not operating, non-operating. Okay? The other thing to note about working capital is it's probably the most volatile item in the entire balance sheet. I'll give you an example. Look at changes in working capital. You track your company. Try this on your company. Take the change in working capital last year. It might be plus billion. Take the previous year, minus 800 million. Go back 2 years, 3 years. It might be minus or plus 1.5 billion. The numbers tend to jump around. And the reason that's a problem is if you take last year's change and make that your base year number, strange things can happen in your valuation. So the first thing we need to do is somehow normalize those changes over time. The other problem with non-cash working capital, and this really throws people off, is, can non-cash working capital be negative? Sure, right? If your non-cash current assets are less than your non-debt current liabilities, you have a negative working capital. You see why that's a problem? Let's say you grow revenues 10% a year. You leave working capital at a fixed percent of revenues, minus 5% of revenues, right? Because you have non-cash working capital that's negative. So as your revenues grow, your working capital gets more negative, right? Your working capital gets more negative, you get a cash inflow every year. So you grow faster, you get even more cash from working capital. Working capital becomes a cash cow that you can milk forever, and you get billions of dollars from working capital, which doesn't make any sense. And in fact, there are entire sectors with negative non-cash working capital where they don't have much in inventory, but they use supplier credit constantly as a way of kind of financing their operations. I'll give you, in fact, 3 companies I valued in the dark side of valuation. This is the 2001 edition, were Amazon, Cisco, and Motorola. Amazon and Cisco actually had both negative changes in non-cash working capital. They became more negative over the period. And their non-cash working capital is actually, as a percent of revenues, a negative number. So for instance, Amazon, non-cash working capital was minus 419 million. As a percent of revenues, it was minus 15.16%. Cisco, non-cash working capital is minus 404 million. As a percent of revenues, it was minus 3.16%. Now, Amazon bothered me more than Cisco. The reason is very simple. It's in the retail business. The retail business, it's unusual for a company to have negative non-cash working capital. What allowed Amazon to pull this off in the late 90s was they were a .com retailer. A lot of publishers wanted to get their names out there, so they would give they'd let Amazon basically take their books. So Amazon would sell the books to you and I, collect the cash, and take 3 months to pay the publisher. So that's basically the float they were using to actually grow. But that's not a long-term viable. I mean, as you get bigger, I'll wager publishers are going to start demanding more reasonable terms. So it's one thing to be a small retailer and get away with this. So as you go through time, I would expect non-cash working capital at Amazon to start moving towards industry average. Yeah. Well, Walmart is an exception. Walmart actually has zero working capital. It's one of the first. In fact, until Walmart came along, the standard in retailing was the 2-to-1 ratio. Do you know 2-to-1 ratio is current assets are supposed to be twice current liabilities. So retailers would try to maintain it. Walmart said, this is stupid. Why are we doing this? They actually try to make non-cash working capital a neutral item. It's not a cash inflow like Amazon, but it's not a cash drain either. You can squeeze suppliers only so much. You still have a huge amount of inventory in a typical Walmart, so there's a pretty big counter item. But they were very good at managing working capital. It wasn't a cash inflow, but it became a neutral item in their cash flows. Yes? No, this has nothing to do with whether you're counting cash or not. This is just to do the cash flow. So if you're counting in net income and interest income from cash in your net income, cash is still being counted in your valuation. This is just to prevent you from treating cash as a drain on cash. It's kind of silly because when you take working capital and it increases because your cash balance went up and you claim to have a negative cash flow, how does it even work? I mean, your cash balance increased from $1 billion to $3 billion. How can that increase be treated as a drain on your cash flows? So it's really to prevent that kind of inconsistency in the process. So whether you're counting cash or not is a separate issue. That shows up in your income, whether you count it as part of your net income, whether you count it as part of operating income. So view them as 2 separate issues. Okay? So this is more to get your CapEx right and to get a sense of what it's draining your cash flows by. Okay? So in the case of Amazon, what I did was I looked at the industry average, 8.7%, but I didn't push. So when I valued Amazon, I didn't push the working capital up to 8.71%. And here was my rationale. If you're a brick-and-mortar retailer, which is what the 8.71% in 99 captured, you need a lot of show inventory, right? You know what show inventory is? You walk into a bookstore. Notice how many sections of the bookstore are completely empty. That philosophy section, valuation section. Nobody's there. Everybody's gathered around that Harry Potter exhibit in the front, right? But if you're a bookstore, you're supposed to have philosophy books. You might even be required by law to have valuation books. But if you're a .com retailer, who knows what your inventory is? For all you know, Amazon has 15,000 copies of Harry Potter and none of Damodaran on valuation. And it doesn't bother them the least. It's not like orders keep coming in every day. Once every 6 weeks you get an order, you say, I'll print the book off and send it when you need it. So it basically means that you'd expect .com retailers to have lower inventory needs than traditional retailers, but they're not going to go to 0. So I actually, when I valued Amazon, used a 3%, which was between where they are now and where the industry average is. For Cisco, I actually left, if you look at the working capital, theirs was minus 3.16%, but they're in a sector where everybody does this. Non-cash working capital is a negative number. I actually allowed them to use working capital as a source of cash for the near term, but when I got to my terminal value calculation, I said, I can't let this go on forever. I can't make working capital a source of cash forever, so I set it at 0% for my terminal value computation. Motorola, their actual working capital is 8.23%. The industry average was about 7%. The last 3 years they were at 8.91%. There I felt pretty comfortable leaving working capital at where it was. So 3 different scenarios, 3 different ways of dealing with it. So what I'm trying to say is when you look at your company, look at working capital, look at the company's own history, look at the industry averages, make your best judgment, move on. Right? Working capital should not be the variable that drives your value for your company. It should be a side variable. It shouldn't be the key variable. So make sure it doesn't become the dominant variable, making your stock go from $20 to $40. But to do that, you've got to look at the entire picture. So let's summarize. CapEx should include acquisitions, R&D, human capital investments. Working capital, be narrower in your definition of working capital, and be careful about what you're assuming into the future. Which brings me to the final dimension of cash flows. So far, the cash flows we've talked about have been cash flows to the firm, right? We start with operating income, we have taxes, we have CapEx, we have depreciation, we have working capital. Let's talk about cash flows to equity. The most direct measure of cash flow to equity is dividends. Everything else is, in a sense, illusion, right? So the dividend discount model, in a sense, says, look, I don't care what your estimate of cash flow is, this is what actually gets paid out. But we do know that companies don't always pay out what they can afford to in dividends. We know that because all you have to do is look at their cash balances, right? $2 billion, $3 billion, $5 billion. In fact, if you look across U.S. companies, 80% of U.S. companies pay out. For every dollar in free cash flow to equity, cash available, they pay out about 60, 70, 80 cents, well below the cash available. So the rationale for using cash flows to equity is you're saying, look, I don't trust dividends. Companies don't always pay out what they can afford to, so I'm going to look at potential dividends. That's where we're going when we try to compute free cash flow to equity. So if you look at the free cash flow to equity computation, the question is, how do you come up with that potential dividend? I'll give you some things you cannot do. You cannot treat earnings as dividends. There are some analysts I've seen who discount earnings. And so why are you doing this? Well, because the entire earnings can be paid out as dividends. Is that true? It is true, but if you do that, what kind of growth rate should you use? 0. The only growth rate that's consistent with discounting earnings is a 0 growth rate. Have any of you seen this book, Dow 36,000? It's one of the stupidest books on valuation ever written. Right? It actually came out at the peak of the dot-com boom, and this is what the authors did. They first took the earnings in the S&P 500 and decided to treat it as dividends. Mistake number 1, right? Then they took the growth rate and decided to use the growth rate of the economy as the growth rate in those earnings. So now you're paying out all of your earnings as dividends and growing 4% a year. And then they made the final assumption, and this capped the whole thing off. They said if you hold stocks for a really long time, they're riskless. Isn't that pretty strange? You know how they back this up, right? They looked at 180 years of data in the US, and they showed that over any 30-year time period over the last 80 years, stock returns would have been higher than T-bond returns and T-bill returns. And they said, ergo, that must mean stocks are riskless if you have a long time horizon, which means that the cost of equity should be the risk-free rate. So here we have earnings being paid out as dividends, 4% growth rate forever, and cost of equity. I'm amazed they didn't come up with Dow 360,000 or Dow Infinity. Right? I mean, in a sense, you can see where this is going. Companies can grow without reinvesting, and it's all riskless, so we should be loading up with equities from now through eternity. So earnings cannot be dividends. Or if you decide to use them as dividends, make sure you use a 0 growth rate. Okay? So what we're trying to measure with potential dividends is not just what's earnings, but what's left over after you've reinvested whatever you need to reinvest to get your growth rate, and after you've made debt payments, interest payments, principal payments, you can't set that aside. So that's the focus with free cash flow to equity. And I'll give you the definition of free cash flow, the standard definition of free cash flow to equity, and we'll ask what-if questions around that. Here's the standard definition of free cash flow to equity. We start with net income. In fact, as we go along, contrast this with how we compute free cash flow to the firm. Free cash flow to the firm, what do we start with? What's our measure of earnings? EBIT times 1 minus T, right? After tax operating income. With free cash flow to equity, you go with net income. Equity income as opposed to operating income. You subtract out net capex and change in working capital, defined exactly the same way we define them for free cash flow to the firm, counting acquisitions, counting R&D. So everything we said about working capital and capex applies here as well. So you start with net income instead of after-tax operating income. You subtract out net capex. You subtract out change in working capital. But here's one final adjustment we did not make when we did free cash flow to the firm. When you borrow money, think like an equity investor. When you borrow money, cash comes into the company, right? It's a cash inflow. When you repay debt, it's a cash outflow. The last item is basically the cash flow captured by debt inflows and debt outflows. So basically you're saying if I have to pay off a lot of debt, it's going to lower my free cash flow to equity. If I borrow a lot of money, that's a cash inflow. So the free cash flow to equity starts with net income, subtracts out reinvestments, and subtracts out that cash flow to debt holders. That's the bottom line. That number, of course, can be negative, right? It can be negative, you're losing money, your net income is negative. It can be negative, you reinvest a lot of money. It can also be negative if you have a lot of debt payments coming due. If you have a leverage buyout, take a look at the free cash flows to equity in the first few years after the leverage buyout. Because you've got to repay all that big debt. You're going to find your free cash flows equity in year 1, year 2, year 3 be big negative numbers because you're trying to retire the debt to get this company back into some kind of steady state before you can take it back public again. So what we're trying to measure with free cash flow to equity is potential dividends. It can be a negative number, unlike dividends, which can never be less than 0. But in most cases, the number you're going to end up with will be higher than what actually you observe as actual dividends. It's a pretty messy computation to make because think about forecasting these numbers going forward, right? Net income, that's not a big deal. We forecast earnings all the time. Net capex, change in working capital, we do that anyway. But now you have 2 additional items you need to forecast year by year. Debt repayments every year and new debt issues every year. Now with a leverage buyout, the debt repayments might be set by schedule. But if you have a typical company, forecasting debt payments and new debt issues in dollar value terms is going to be very difficult to do. So here's a shortcut that you can use with a caveat. The shortcut basically works if you're willing to make an assumption. And here's the assumption you need to make. You need to tell me what proportion of your reinvestment, and by reinvestment I include both net capex and change in working capital, what proportion of the reinvestment is going to come from debt and what proportion is going to come from equity. So give me a number. You have a company. I come to you and say, well, what proportion are you going to fund with debt? You say 20%. If 20% of your reinvestment is going to come from debt, 80% has to come from you. Okay? This is all about you as the equity investor. So I'm going to start with net income. I'm going to subtract out 80% of net capex, and that's what you have to come up with, and 80% of working capital, and I'm going to end up with a free cash flow equity. It's a much quicker computation, but it works only if you're willing to give me that debt ratio. If you hem and haw and say, look, I don't know what the debt ratio will be, then I'm going to say do it the long way. Forecast our debt payments, forecast our debt issues, do it right. But if you're willing to say it's 15, 20, 30, 40%, whatever the debt ratio is, then I can compute the free cash flow to equity much more easily. So 2 different definitions. Don't mingle the 2. You can use one or the other. Which one you use will depend on whether the debt ratio is stable, in which case you can go with this one, or if it's unstable, in which case you have to go with the first one and forecast out the individual items. Yes, Patrick? That's a good question. Debt ratio is stable, and old debt comes due. The only way to keep your debt ratio stable is you'll have to issue new debt. That's the plus of this debt ratio being stable is that old debt repayment will never be repaid with equity, because if you did that, your debt ratio will come down. So that's what allows us to make the assumption, but it's a pretty strong assumption. Let me take an example, because it's kind of abstract. This is actually a company you should be familiar with, right? Disney from Corporate Finance. If you're not, I'll go through the numbers. These are the numbers from 2003. Net income of $1.533 billion, capex of 1.746, depreciation, it says per share, cross it out. Right? Hopefully it's not per share. 1,134 million. The working capital increased by 477 million during 2003. So I've given you net income, capex, depreciation, change in non-cash working capital. I also throw in an additional item to make your life simple. I say, you know what? Disney settled into a steady state. They're going to fund 23.83% of their reinvestment from debt. And basically to get that, I looked at the last 5 years, and 76.17% from equity. So we can use the shortcut, right? Debt ratio is stable. So I start with the net income. I subtract out net capex, 1746 minus 1134 times 1 minus the debt ratio. Why 1 minus the debt ratio? Because all I care about is the equity portion of this. Then I do the same thing with working capital. end up with a free cash flow to equity of 704 million. Their actual dividends were 345 million. Think about it. If you use the dividend discount model, you'd have used the 345 million as your base and grown from there, right? But the company's paying out less than half of what it can afford to. You're going to undervalue the company because that difference in cash is going to sit around the company. It belongs to you and I as stockholders. So when we use free cash flow to equity, it's not even that we're saying the company will pay the difference out. We're saying whatever difference is not paid out is going to accumulate as a cash balance, and it belongs to us as stockholders. So that's the idea behind the free cash flow to equity approach. It's not that you can force companies to pay it out, but that whatever doesn't get paid out belongs to you and I as stockholders in the company. Any questions on mechanics? So basically, this works only if the debt ratio is stable, right? Yes. Malik.
You mentioned that Disney's in steady state. So that's the reason why
You could use the ratio. If it's not in steady state, then I need two items, right? I need debt repayments and new debt issues. Those will be in the statement of cash flows. It's not difficult to get the numbers for last year. So I can compute the free cash flow to equity for any company for last year. The difficulty is when you sit down to make projections on these numbers, those numbers are not easy to project, right? Because it's not like they're the same amount every year. They kind of jump around. That's really the problem. It's not getting the numbers for 2003, but making those forecasts going into the future. So if it's not in steady state, that's what you need to do. Instead of using the debt ratio, you'd have to get debt repayments, new debt issues, and forecast each of those items out going forward. Yes, Kevin? It included R&D and acquisitions, right? That's actually a good question. The question was about the capital spending, R&D and acquisitions. Luckily, Disney has relatively small R&D. They did have a big acquisition, but it was actually in 1996 when they bought ABC. So it includes a portion of that acquisition. Rather than count the acquisitions only in the year that they happened, I went back and averaged over time. So it's a few little mechanical details, but I'm trying to kind of normalize the numbers so I can use it as a projection. Yeah. Yep. 5 years. I looked at 5 years. When in doubt, look across time, because companies do strange things in individual years. So wherever you can, if you have the history, look at the history and see if you can extract something from it. Okay. Just.
I've seen companies in India which are kind of run by these families, and they own about 55-60% of the company, and 40
Right.
is the market. They seldom issue dividends, so the company basically, the proprietors kind of
Hold the cash.
hold the cash in the company. And how do you value it in terms of, because you will have very little power to fight the corporate.
I think that's a good point. Do you get the point that Opportunity is making, which is, what did I say about the difference between dividends and free cash flow equity? I said it belongs to you as stockholders, right? What if it doesn't? What if it goes into this big gray mass and you have no idea where it goes or what happens with it? Then the most conservative thing to do is say, look, the cash will never come to me. These guys are going to steal me blind. I'm just going to count what I actually get. Okay? The reality is the answer is going to lie somewhere in the middle. They're probably not going to steal 100%, so you'll have to make a judgment. Will they steal 60%, 40%, or 33%? And it's a very strange place to be. But that's what happens when corporate governance becomes weak and you don't own the assets of the company, even though you're a stockholder in the company. So do the dividend discount model, do a free cash flow equity model, see where you're going to put yourself in the middle. Now, let me take these numbers and change just the debt ratio. Okay, so let's suppose net income, net capex, change in working capital, I try a 40% debt ratio. What's going to happen to my free cash flow equity if I go from 23 to 40%? Is it going to go up or go down? It's going to go up. Let me try 60%. It's going to go up even more, 80%. In fact, this looks like a free lunch, right? If I want to increase the value of this company, all I have to do is keep increasing the debt ratio, and your free cash flow, and you can see why, right? The more of my reinvestment I cover with debt, the less equity I have to come up with. So my value of equity should increase as my debt ratio goes up, right? What am I missing here? Cost of what? The cost, but cost of capital doesn't matter because this is the cash flow equity. All I care about is cost of equity, right? And to get the cost of equity, I use hopefully, if I use a regression beta, I'm sunk. If I use a levered beta, as my debt to equity ratio goes up, the other shoe is going to drop. And here's what the other shoe is going to look like. My cash flows will increase as my debt ratio goes up. My beta will go up as my debt ratio goes up. So my cash flows will be higher. My cost of equity will also be higher. So let's see how ready you are to make, without even looking at the numbers, to make a final judgment on what that present value is going to look like. Because both the cash flow and the discount rate have gone up. Here's my question for you. Increasing leverage will increase your cash flows. Increasing leverage will increase your cost of equity. Which effect is going to dominate? And as I read through these statements, if you think this is the right answer, just check it off. Increasing leverage will increase value because the cash effect will dominate the discount rate effect. Increasing leverage will decrease value because the risk effect will dominate the cash flow effect. Increasing leverage will not affect value because the two effects will exactly offset each other. Or any of the above, depending upon the company you're valuing. In fact, is one of these the Miller-Modigliani theorem by any chance? What does the Miller-Modigliani theorem say? It doesn't matter how much debt. In fact, the third statement here is the Miller-Modigliani statement that increasing leverage will affect your cash flows, but your discount rates. So that's one way to think about the Miller-Modigliani theorem, is there is no free lunch. You can't just increase the value of your equity by playing games with debt. Of course, the LBO guys will say, no, it's the first one. Increasing leverage will always affect increased value because the cash flow, it's almost take us on faith. The cash flow effect will dominate the discount rate effect. Now, of course, you've got the counter LBO guys who are coming out of the groundwork now saying debt is a terrible thing. No company should ever borrow money ever again. We should all go to zero debt ratios. They're actually buying into the second one. Increasing leverage will always reduce value. But common sense tells you that it can't be one statement that applies across all companies. That if I gave you GE, the answer might be one number. If I gave you Hormel Foods, it should be a different number. You cannot make one judgment that cuts across companies. Making statements about debt that are generic statements that apply across all companies is always going to get you into trouble. So if you look at the cash flow effect and the discount rate effect, in some cases the cash flow effect is going to dominate the discount rate effect. In some cases it's going to go the other way. A little later in this class we'll come back and revisit this because we did this in corporate finance as an optimal capital structure decision. But we'll come back and revisit this in the context of increasing the value of a company. But this is what it basically boils down to, is which effect is going to dominate for my company for the next segment of debt. Because the answer might be different for the second segment and the third segment for the next segment of debt. Any questions on free cash flow to equity and the dynamics? So when you're sitting down to value a company, as you keep increasing the debt ratio, if you see free cash flow to equity go up, do not be surprised. That's what you expect. But don't expect your value of equity to also go up just because your free cash flow to equity is higher, because your cost of equity is going to be the counter factor here. So that's all I wanted to say about cash flows. Let's talk a little bit about growth. I have some good news here. The quiz is only through cash flows. I'm such a gracious and good person. Right? So you can stop in chapter 10. You don't have to do, so you can actually go to sleep now. You're saying nothing. This is not going to be in the quiz. But growth is fairly straightforward. You're going to wish that you had growth after I go through growth. That will be the easy part of the quiz. Right? So let's talk about growth. There are three ways you can estimate growth, generically. One is you can look at the past, right? So when I ask you how fast will your company grow, first reaction is let me look at the last 5 years, the last 10 years. It's called historical growth. The second is to cop out and look around you. For what? Maybe other people are estimating growth for my company and I can get away using their growth rates. And the third is you can look inside the company and based on what it's doing, make a judgment about growth. I call that an intrinsic or a fundamental growth. Historical growth, outside estimates of growth, and fundamental growth. Let's start with historic growth. That should be the easiest of the numbers to kind of get consensus on, right? All we're doing with historical growth is we're looking back over the last 3, the last 5, the last 10 years and say, how quickly has my company grown over that period? But even that very simple computation can create some big differences across analysts. Let's see why. It depends on how far back I go, right? Whether I go back 3 years, 5 years, or 10 years, I can get very different growth rates. It depends on whether I compute an arithmetic average growth rate or a geometric average growth rate. We saw this with risk premiums, so the same thing applies with growth rates. If you have 10 years of growth, you add the 10 numbers and divide by 10, or you look at the starting number and the ending number. It depends on what measure I'm looking at. Revenues, operating income, net income, earnings per share, I can get very different growth rates. And there are a couple of mechanical issues that can really throw you off. One is, what happens when my company goes from negative earnings to positive earnings? How do I even compute a growth rate? And the other is, as your company scales up, as you go from a really small company to a really big company, you've got to watch out because the growth rates you get by looking backwards might not be good estimates of the growth rate looking forward. So let's look at those mechanical issues. Let's start with the first one. Right? I took Motorola, this is way back, in 2000, and I looked at 6 years of numbers. So basically I went and looked at the 10Ks each year. I pulled up revenues, EBITDA, and EBIT. In fact, I have net income and earnings per share as well, which I haven't even shown you. So those are 6 years of numbers. I just computed the change every year in each of the numbers. I first computed the arithmetic average, 7% in revenues, 10.89% in EBITDA, 42.5% in EBIT. Looks pretty good, right? On an arithmetic average basis. I then did the geometric average. Do you guys know how to do the geometric average? What do you have to do? Take the ending number, divide by the starting number, and raise to the power 1/5, right? Because you have 5 years between the two numbers. So you don't even need the middle numbers anymore. With the geometric average, the revenue growth rate was 6.82%, 5.39% for EBITDA, 4.31% for net income. Here's my question. It's kind of a statistical question. If arithmetic and geometric averages, the differences are obviously much lower for revenues than for net income. Why is that? Or for operating income. Why are the difference between arithmetic and geometric average increasing as I go from revenues to EBITDA to operating income to net income to earnings per share? First, let me ask you a different question. When will the two numbers be the same, arithmetic and geometric averages? You have 8% growth rate every year. You have 0 standard deviation. Arithmetic and geometric averages are going to be the same, right? There's your answer. The greater the standard deviation in the numbers, the greater the difference between arithmetic and geometric averages. And as you move down the income statement, numbers will get more volatile. Revenue growth is going to be less volatile than EBITDA growth. EBITDA growth is going to be less volatile than EBIT growth. EBIT growth is going to be less volatile than earnings per share growth. Here's a note of caution. You go into Yahoo Finance, they actually give you a growth rate in earnings over the last 5 years. I have never trusted that number. Maybe you will, right? But take a look at that number and see if you can back it out, because they have the actual earnings. I have never been able to back into the number precise. I don't know what they do to get to that number. Whether they use arithmetic averages, geometric averages, some number in the middle. It's actually very difficult. You see service growth rates actually come up with that number because it depends on so many choices they make. In fact, starting at a different point, ending at a different point will give you different growth rates. So you start in 99 instead of 90. 99 is a terrible year to start any of these numbers because the economy is doing so well and revenue growth rate is so high. If you make 99 your starting point, you're always going to look much worse than if you make 96 your starting point or 2001 your starting point. So look for those little tricks that people play because it will allow them to kind of manipulate the growth rate. Okay? So when you look at historical growth rates, at least be aware of how it was computed because it can make a big difference. Okay? Here's a kind of mechanical test. Okay? I'm going to come to you with a company, in this case Time Warner. Time Warner in 96 lost money. The earnings per share of minus 0.05 cents. In 97, its earnings per share is expected to be 25 cents. So it's going from minus 5 cents to plus 25 cents. I have a very simple question. It's a mechanical question. What is the growth rate in earnings for 97? Let's go. What's a standard definition of growth? How do we compute it? We take the change in earnings, right, which in this case is 30 cents minus 5 to plus 25. And we divide by what? The earnings per share previous year. So plus 30 divided by minus 0.05 gives us a growth rate of minus 600%, which makes no sense at all because I went from a negative number to a positive number, right? So I have a question about, you're an analyst, you have to come up with a growth rate. If you show this to your boss, he's going to freak out. So let me give you some solutions. You tell me which one you're most comfortable with. Maybe you can just make the minus into a plus. That's really the problem, right? The 600% you can live with. It's a minus that you can't live with. So let's put another notice. Of course, mathematically, this would be kind of not kosher. So here's a mathematical solution. You took the change in earnings in the numerator. That wasn't the problem. What is the problem? The denominator was negative, right? You could use the higher of the two numbers. Write it out as an equation. Make it look sophisticated. Maximum of earnings per share last year and this year. I know that's not the way it's usually done, but who cares how it's usually done? In which case, if you take the higher of the two numbers, you take 25 cents in the denominator, you end up with plus 120%. Or maybe the truth here is you cannot compute a growth rate. Go from a negative to a positive. I mean, you could play all kinds of tricks here, right? Absolute values, higher the two numbers. But the true answer might be if I asked you what's the growth rate at Time Warner, you can tell me the earnings grew by 30 cents, but you can't convert to a rate. I think the last answer is the most honest answer. When you have companies going from negative earnings to positive earnings, don't even waste your time computing a growth rate. What you're getting is useless. You can't use this for projections. I can't use plus 600% to project the growth rate for Time Warner for the next 5 years. It's going to give me absurd numbers. I can't use 120% to project the growth for the next 5 years. I'm going to get strange numbers. In a case like this, I might say, look, I cannot use the historical growth rate. I have to figure out a different way of projecting growth for the company. And remember, there are two other ways. You can look at the analyst estimates. You can look at fundamentals. But when you cannot compute historical growth rates, don't bang your head against the wall trying to come up with concoctions that will give you a number that looks reasonable, because the honest answer might be for some companies you cannot compute the historical growth rate. In fact, I've already got about 3 emails from people valuing companies. There are people actually getting started in the valuation. This is to get your guilt going. And they have companies that have been around only 2 years, so they say, I cannot compute a historical growth rate. Should I switch companies? Don't. Historical growth rates are not the only way to estimate growth. So if you cannot get a historical growth rate, it's not the end of the world. Let's talk about another issue with historical growth. You guys familiar with Callaway Golf? Came out of nowhere in the 90s, huge hit, Big Bertha golf clubs, you know. Here's their glory period. They went from 1.8 million in net profit in 1990 to 122.3 million in net profit in 96. So if you look at their growth rate, the geometric average growth rate was 102% over that period. That's in fact a fair estimation of what they actually grew at. So let's say I'm an analyst valuing Callaway Golf. In 97, I sit down, I look at the historical growth rate, 102%. And say, well, they grew 102% over the last 6 years. I'm going to project that growth rate for the next 5. Let's see what happens, right? The power of compounding. Here's what their net profit will look like if I let 102% growth rate continue for the next 5 years. I mean, we all would need 3 big, even if you don't play golf, we'd all have to buy three big Berthas and put them in the closet for this to work. You'd be amazed at how often you see this happen in valuation, because we get so caught up in percentage growth rates that we don't step back and look at that revenue number and say, is that even possible? Right? In fact, I have a very simple test for revenues. If your revenues exceed 100% market share, you have a problem. Okay? And there are an amazing number of valuations. You look at the revenues in year 10, you look at the total market, how the heck did you get to a 223% market share there? And the reason it happens is people are not even looking at the absolute values. It's 20%, 20%, 20%, 20%. What they're forgetting is 20% in year 6 and 20% in year 1 deliver vastly different dollar values. So if you're doing a growth rate, at least check the dollar values to make sure that they are reasonable. Especially if you're working with a company that used to be a small company, that's now become a bigger company, watch out for those historical growth rates and projecting them into the future. So that's historical growth. Do it. I mean, but I am very, very reluctant to value a company based on historic growth. It's in fact my biggest problem with modeling classes, not with Dan's class. Dan Godet's class is a great class. But modeling classes in general, this is what tends to happen. You have line items, and you have historical growth for each line item. And every line item then grows with the historical growth rate. Strange things will happen to your valuation when you do that. Just watch out for that. Which brings us to the second way of estimating growth. Let somebody else tell you what the growth is, right? And if you have a company that is tracked by analysts, this number is pretty easy to pull up now. You go to Zacks, you go to Yahoo Finance, you have an expected growth over the next 5 years. You go to Bloomberg. Somebody's done my dirty work for me already. Let me take that growth rate and use it. Let's take a look at how much information there is in that growth rate. So you have a company. You're trying to value the company. The analyst is saying 12% growth over the next 5 years. Let's see how much information there is in that number. Let's start out with some basics. Do analysts spend a lot of time focusing on earnings per share? Absolutely. Do they spend a lot of time on growth rates? In fact, I would say 70% of their time is spent for check. So presumably they must bring something into this process. There must be some information, the 12%. The only way to test to see how much information there is to look at the actual evidence. When you look at an analyst's forecast of earnings per share, is that forecast better than a forecast you'd have got by using, let's say, a time series model? There have been people actually who've studied this, and the results are actually pretty depressing for analysts. And so these are 3 different studies I'm going to quote here. These 3 studies did a very simple test. They took the earnings per shares forecasted 1 quarter ahead. So this isn't even long-term forecast. Next quarter's earnings per share forecasted by analysts. And they compared those forecasts with a time series model, where all they did was took past earnings and projected out next quarter. And then they looked to see which one was closer to the actual earnings per share. Very simple test, right? They computed the standard error of the forecast. Here's the good news. Every single study found that the analyst forecast was better than a time series model. Here's the bad news. Not by much. Look at the improvement. 31.7% forecast error the analysts, 34.1%. So that's a 2.4% improvement in forecast. And how many millions do we pay for this improvement? Doesn't sound like much, right? It's minuscule. And here's even worse news. That's for 1 quarter ahead. That's their best forecast, actually. As you go from 1 quarter ahead to 4 quarters ahead, even that 2.4% disappears. And with 5-year ahead forecasts, time series models actually do a better job than analyst forecasts do. It's kind of a quandary. I mean, these people spend all day, all week, all year, all their lives forecasting growth. You'd think that they would deliver something more than a time series model, right? So how do you explain this? How come analyst forecasts of growth are not much better than time series models? I'm sorry? Well, maybe they use, in which case we should dispense with the analysts and just go with it. So it's so much cheaper. I could build a time series model with past data and do it. So biased estimates that maybe they give the earnings per share they want to see rather than expect to see. Maybe that could be it. Now, I actually did this at an analyst conference about 5 years ago, and they weren't too happy about this table. And they came up with every conceivable excuse. First, they blamed the SEC. You know why, right? What did the SEC do a few years ago? What is the rule that they created a rule that prevented analysts from managers from talking to analysts. They said all the SEC, before the SEC came along, we were much better, but now that they've prevented this insight into management, they called it insight, but basically inside information, we're not as good. But then I said, you know what, these studies are all from the 70s and the 80s. This was well before the SEC restricted you. You were doing all kinds of stuff on the side that would be illegal now, but you still weren't doing very well. Then they came up with the second excuse. He said, it wasn't us, it was those bad analysts outside. This is the average. We're the good ones. I said, okay, let's look at the best of you. Is there an analyst hierarchy? Do the best analysts go somewhere? Or is there in fact, have you ever heard of the All-America? All-America teams in football. There's an All-America Equity Research Analyst Group. In fact, it's a very prestigious place to be. In most investment banks, if you're an equity research analyst, you make the All-America team. Institutional investor picks it. You get a $2 million bonus, $3 million bonus. So it's if you're an analyst, this is your pinnacle of your existence. In fact, many analysts, after they become All-America analysts, add that to their name. Dan Brown, All-America Analyst. So this becomes part of wherever they go. I'm Dan Brown, All-America Analyst, right there. Right? CFA, CPA, AICPA, et cetera, every alphabet in the soup right there after that. So maybe that's it. Maybe we're looking at the wrong group. Maybe we should look at All-America Analysts. And there was actually a paper that did this. Right? They looked at All-America Analysts and asked the question, are All-America Analysts much better at forecasting earnings than this riffraff? They looked at the year before these analysts became All-America Analysts, and they found something very strange. The year before they became All-America Analysts, they were actually worse than the average analyst in forecasting earnings. So whatever institutional investor does to pick the All-America Analysts, how well they forecast earnings is not one of the inputs. It turned out that the biggest factor driving it was how often you got your name in the Wall Street Journal. Doesn't matter whether you said stupid things or smart things. If you got your name in there, you got a much bigger chance of being an All-America Analyst. But here's the amazing thing that happened. The year after they were chosen as All-America Analysts, they magically went from being below average to above average. This is the self-esteem issue. Maybe their self-esteem rose, and once it rose, their forecast. What do you think happened?
I think people started listening to them and buying their stuff.
But this is about earnings. This is not stock price going up. This is actual earnings forecast became better.
I think people probably, management started able to their.
What do we say the biggest source of information is? You get on the phone, you call the manager, right? I'm an equity research analyst. They hang up the phone. I'm an All-America equity research analyst. They stay on the phone. It gives them a megaphone, right? So I think the secret here is you become an All-America analyst, your phone calls get answered. Your emails get responses. You don't go to the junk pile anymore. So if the story here is it's because the better, that's not it. I mean, across the board, analysts do seem, and if they get an advantage, it's a marginal advantage coming from the fact that they have access to management. but it's not much. The reason that Access is not that useful is the information you get from managers is always going to be biased, right? It's not like managers are going to spill the beans on bad stuff coming up. You're going to get a lot of the news about the good stuff. Not Bear Stearns, CEO, is not calling you in February and saying, we're going to go bankrupt in 3 months. We just want to let you know right away. Okay? So you actually get one-sided information. And here's the evidence that, in fact, the information is one-sided. When you see buy recommendations made by analysts, the effect is fairly small, and it dissipates very quickly. The average effect is like 3, 4, 5%. You often see the Wall Street Journal, Goldman Sachs equity research analyst puts a buy recommendation, stock price jumps up. Track those stocks. Within 2 to 4 weeks, within 6 months, it's gone. But when you see sell recommendations come from analysts, you see a much bigger impact on the recommendation, and it stays. Because the argument that investors use is analysts are not going to put out sell recommendations unless they know something really bad about the company. So it tends to stick much more. So what this tells me is, when I see a buy recommendation, I completely ignore it. When I see a sell recommendation on the stock that I'm valuing, I'm going to sit up. Maybe this guy knows something. It's probably illegal what he knows, but I'd like to know what he knows. Okay? So this is actually something that has always bothered me, because I have probably 200 students who are equity research analysts. I go talk to equity research departments. The question is, these are smart people. How come they're not better at forecasting earnings? And I've come up with 5 possible reasons. One is tunnel vision. You know how this gets formed? If you're hired as an equity research analyst, you're first put into a sector, right? Telecom, cable, retail. And then that becomes your focus for the rest of your life. You forget the rest of the world even exists. It's amazing how often analysts get so focused in their sectors, they can't step back and look at where that sector fits into the bigger market. That's why if you're a .com analyst in 99, you didn't think your valuations were that weird, right? Because you talk to other .com analysts, and you looked at only .com stocks, and they all look fine, 300 times revenues. Oh, that's cheap. Everything trades at 500 times revenues in this sector. So that's the first problem. Second is Lemmingitis. In fact, try this as an experiment. Next time you see earnings per share, or sometimes you see an analyst say, so-and-so at an investment bank increase their expected earnings per share for the gap for the next quarter from 27 cents to 31 cents. Track the news items for the next couple of days. You're going to see an amazing number of other analysts jump on the bandwagon. One analyst increases earnings, 7 other analysts will go out and increase earnings. Okay? It's Lemmingitis. Stockholm Syndrome. You know Stockholm Syndrome? This is when you're a hostage. You start identifying with the people who take you hostage. You say, what's this got to do with? Your job as an equity research analyst is to value companies, not to identify with the managers of these companies, feel their pain. I mean, that's not why you're there. You say, oh, I love the CEO. I feel terrible that that's not your job. But the problem is, as an equity research analyst, you get access to top managers. You get to know them. It's human nature. You start liking the guy. It's tough for you to put a sell recommendation on the Trump casino. I can't imagine anybody liking Donald Trump, but you're afraid he'll sue you or do something to you. In fact, Donald Trump did threaten to sue an equity research analyst to put a sell recommendation on one of his companies, and he got the brokerage house to fire the analyst. It's very craven of them. It's a Philadelphia-based brokerage house. They fired the analyst because they put a sell recommendation on it. Factophobia. Look at equity research reports. There's an amazing reluctance to talk about numbers. They like using words like dynamic and strategic, and I mean, there's a lot of words, and you say, what exactly is dynamic here? What are you talking about? What changed? But talking about numbers comes as an afterthought, right? There's the target price, and then the rest of the report says, what are the numbers? And finally, there's the Jekyll-Hyde. You know what the Jekyll-Hyde phenomenon is? They're investment bankers, or they're equity research analysts by day, investment bankers by night. Okay? This is the Jack Grubman effect. Jack Grubman used to boast about the fact that as an equity research analyst, he brought in $200, $250, $300 million in investment banking revenues to Solomon. You cannot be an equity research analyst and be drumming up investment banking business at the same time. It doesn't fit. So I think the structure of the process kind of eats away at the quality. You can get smart people, you can put them into the structure, but over a period, you're going to see whatever quality they brought into the process start to dissipate because of what they're asked to do. So we've got to change the way we do equity research. If we want high-quality equity research, this system has to change. The way it's structured, it's not Elliot Spitzer's fault that it's not working. It hasn't worked for a much longer time period. It's a system that is really not creating quality research, and unless we can change the system, I don't think it's going to change. You can pass, or you can sue as many people as you want. The system is at fault. Yep. I'm old. Yeah.
Do you find that our class predicts stocks better than
You're brilliant. You will never make a mistake. Are you saying that? Are you saying that are human beings getting more intelligent over time or less intelligent over time? Is that the question? Is there learn?
efficient market syndrome, or do you believe that analysts?
Why is the efficient market a syndrome?
I mean the efficient market theory. That,
Oh,
that
okay.
you can't hit the market.
You're giving away your bias by calling it a syndrome, but that's okay.
Or do you want to say that people become stupid after they leave your class and go to the industry?
I think we all become stupid. I won't say I will include myself. We all become stupid in the good times, right? Because we get lazy. We all become smart in the bad times, but it's too late to fix the mistakes we made when we were stupid. It's human nature. We're going to go through cycles. This isn't a learning cycle. So you learn 3 steps and you forget it all. It's amazing how much amnesia there is in this process. People out there will say, now, this will never happen again. I will never make this mistake again. I guarantee you, 10 years from now, we'll be talking about another mistake that looks very much like this one. Okay? Did I lose my mic? I only 4 minutes left. So let me make some general proposition about analyst growth rates, and then we'll kind of wrap up this section. First, as a general proposition, there's far less private information in analyst forecasts than we think there is. Because we think of equity research analysts as being having these inside source of information on all kinds of good stuff, and there's very little of that. In fact, the only private information they often get comes from the company, which kind of cuts into the quality of the information. So my advice to you is when you sit down to evaluate your company, take a look at the analyst forecast. I'm not saying ignore it, but then set it to the side. Don't let it drive what you do. What I mean by that is if you come up with a 4% growth rate, there's a 12% analyst estimate, you're going to be tempted to kind of keep nudging that number up. Don't do it. This is your valuation. This is not the analyst valuation. You cannot let the most critical number in your valuation be outsourced to an analyst. So be aware of what that number is. Try to find out what's driving difference between your number and that number. But if you cannot find a good reason, go with your number. Okay? But don't assume that that number somehow has information that is special information or unique information that you don't have access to. Any questions about analyst growth rates? We're going to stop there. When we start back up next after the quiz, we'll start with fundamental growth rates. Right?